Ever get that feeling when you're trying to understand a company, maybe for an investment, maybe just curious, and you're just drowning in information?
Oh, absolutely. Reports, news, opinions. It's like drinking from a fire hose sometimes.
Exactly. Well, that's what we try to cut through here on the Deep Dive.
Yeah.
Today, we're taking a close look at Palladyne AI Corp, ticker PDYN.
Right. Now, PDYN is hypothetical, just for our analysis today.
But the world it operates in artificial intelligence is very, very real.
Precisely. And we've got this START research report on PDYN dated May 15th, 2025. Our mission really is to pull out the most important stuff for you.
Yeah, give you the key insights. What does PDYN actually do? What's its potential? What are the real challenges it faces?
Without burying you in jargon. Think of it as your shortcut to getting a handle on PDYN.
Okay, so Palladyne AI, PDYN, what's their core business? Let's back this.
So the report says they're all about AI solutions for industry. Specifically, think industrial automation and making supply chains smarter.
And their main model is this AI as a service thing. AI.
Exactly. AIAS, they've got two main products mentioned, Vision AI.
Right, that uses machine learning, computer vision for quality control, yeah, like spotting defects.
Spot on. And the other is Palladyne AI. That's their platform for supply chains, demand forecasting, inventory, logistics, supplier stuff.
Okay. And this AIAS model, what's the advantage there?
Well, the big thing is it lowers the barrier for companies. You don't need a massive upfront investment in, say, hardware or building your own AI team.
Makes sense. Easier to adopt.
And PDYN is apparently exploring this pay-per outcome pricing for Palladyne AI.
Pay-per outcome, how does that work?
Instead of just a flat subscription, the idea is customers pay based on the results they get. So better forecasts, lower inventory costs. PDYN's fee is tied to that success.
Huh. That's interesting. It aligns their goals with the customers, right?
It does, but it also means PDYN really has to prove its value consistently if they don't deliver the outcomes.
The revenue could be shaky, more variable than a simple subscription.
Potentially, yeah. Higher churn risk, maybe, if they don't hit those targets. It's an interesting trade-off.
So who are they selling this to? Which industries?
The report points to manufacturing, automotive, consumer goods, logistics. Pretty broad industrial focus.
And the customers? Big companies? Small ones?
It seems like a mix. From SMEs, smaller businesses just dipping their toes into AI and automation.
Right.
All the way up to large corporations looking to optimize what they already have.
Okay. So zooming out, what about the market itself? AI for industry, for supply chains? Is it growing?
Oh, it's growing like crazy. Exploding, really. The report pegs the global AI and supply chain market at nearly $10 billion in 2025.
$10 billion, wow.
And projected to grow at something like 39% CAGR through 2034 annual.
39% annual growth, that's huge.
It is. And the U.S. market, which seems key for PDYN, is growing at a similar pace. Adoption rates are climbing fast, too, like 46% of companies using AI in supply chains already in early 2025.
So massive tailwinds for companies like PDYN.
Definitely. The report also mentions broader trends in automation, like plug-in produce, collaborative robots or cobots, AI for quality control.
All things that seem to fit right into what PDYN offers with Vision AI and Palladyne AI.
Exactly. But, and this is important, they're not alone. It's a crowded space.
Right. Who are they up against?
You've got the big enterprise software giants like SAP or Oracle who are adding AI features to their existing platform.
The incumbents.
And then you have a whole swarm of other AI startups, all fighting for a piece of the pie. So PDYN needs a clear edge.
A distinct value proposition. A moat, maybe?
A moat would be ideal. The report kind of hints at a potential data network effect.
How would that work?
Well, if PDYN collects anonymized data across all its customers...
Yeah, they can use that data to make their AI models smarter.
Exactly. The more clients they have, the more data they get, the better their AI performs. That creates a feedback loop that's hard for smaller competitors to match. It could become quite sticky.
Okay, so booming market, fierce competition, need for a strong moat. Let's switch gears a bit. What about the people running the show? Management. How important is that here?
Critical, especially in a field like AI that's changing so fast. You really need the right leadership.
What does right look like in this context, according to the report?
Well, ideally, you'd want a CEO who knows how to scale a tech company. You need a CTO with deep AI expertise, obviously.
Sure.
And maybe a CFO who really understands SaaS finance, the subscription models, metrics, all that. Vision and innovation culture are key.
And it's not just their skills, right? It's also about whether their interests align with shareholders.
Absolutely. You want management to be thinking like owners. How is their compensation structured? Does it reward long-term value?
And do they own stock themselves? Skin in the game.
Exactly. Significant insider ownership is usually a good sign. It means their financial success is tied directly to the company's performance.
Okay. The report also mentions capital allocation, how PDYN uses its money. What should we look for there?
This is crucial. Is management being smart with the company's capital? For a growth company like PDYN, you'd expect heavy investment in R&D.
To improve the products, build that moat we talked about?
Right. Enhance solutions, maybe develop new ones. If they do acquisitions, are they strategic? Are they paying reasonable prices?
And things like buybacks or dividends? Probably not yet.
Unlikely at this stage.
Yeah.
The focus should be reinvesting for growth. You want to see them generating good returns on the capital they do invest. ROIC, return on invested capital, that's a key metric to watch.
Managing debt wisely, I assume?
Prudence with debt is important, yes. Overall, you want a management team focused on the long term, not just, short-term financial engineering, especially in a volatile market like AI.
Makes sense. Okay, we covered the business, the market, the management. Now let's dig into the financials. What do the numbers tell us about PDYN's health?
This is where the picture gets quite interesting based on the hypothetical data. From 2020 to Q1 2025, you see strong revenue growth. It was around 50% annually, though the report notes it's starting to moderate a bit, maybe to around 42% TTM, which is normal as you scale.
It's still very strong growth, though. What about profitability?
That's improving significantly. Gross profit margin has climbed to a healthy 72%. That suggests they have some pricing power.
72% gross margin. That's pretty good for software.
It is. And importantly, they seem to have crossed the profitability threshold. Operating margin turned positive, now around 21%.
Wow, okay, so they're actually making money on operations now.
Yes, and net profit margin's positive too, around 16% and growing. Earnings per share are increasing.
And cash flow, that's always critical.
Also positive and growing. Both operating cash flow and, crucially, free cash flow since 2022. That means they're generating enough cash to fund operations and investments without constantly needing outside money.
That's a big milestone, positive free cash flow.
Huge. And their return on invested capital is improving too, up to 19%. Debt is low debt to equity at 0.14, and their current ratio is strong, 3.2, so good short-term liquidity.
So the financial picture looks pretty solid. Transitioning to profitability, generating cash.
Definitely a positive trend. The report also dives into some specific SaaS metrics.
Ah, yes, the alphabet soup CAC, LTV, NRR.
Right. So customer acquisition cost, SAC, is estimated at $50,000.
Okay, cost to get one customer.
And lifetime value, the total revenue they expect from that customer is around $250,000.
So LTV to CAC is 5 to 1.
Exactly, a 5.1 ratio. Generally, anything above 3.1 is considered pretty good in SaaS, so 5.1 is quite strong.
What else? Churn.
Annual churn rate is about 6%. That's the percentage of customers leaving each year. 6% is respectable, kind of in line with benchmarks.
Okay.
But the really impressive one, I think, is net revenue retention, or NRR. It's at 115%.
115% NRR. So even after accounting for churn, the revenue from remaining customers is growing by 15% year over year.
That's exactly what it means. Existing customers are spending more over time, maybe upgrading, maybe buying more services. It shows the product is sticky and customers see increasing value.
That is powerful. It suggests they're not just good at landing customers, but keeping and growing them too.
Precisely. It fuels growth internally. The report also mentions a challenge in the broader SaaS world, low license utilization, like 47–49%. People paying for stuff they don't use.
Right. Shelfware.
Yeah. PDYN's focus on ROI, especially with that paper outcome idea, could actually be an advantage there. Customers are probably more engaged if costs are tied to results.
Good point. So how do these PDYN numbers stack up against the industry generally?
Well, the revenue growth aligns with that high 39% AI supply chain market growth we discussed. The 72% gross margin is right in the sweet spot for good SaaS companies, maybe even a bit high.
And the operating margin?
Trending towards the higher end of typical SaaS benchmarks, which might be 15–25% or more for mature companies. So looking good there too. Low debt, strong liquidity. Financially, they seem quite stable.
But the valuation, that's the catch.
That seems to be the main flag from a value perspective. The report implies hypothetical PE and PS ratios are pretty high, much higher than the S&P 500 average. maybe more in line with other high-growth AI stocks, which were trading, very rich multiples. Think PE around 83, PS around 29.5 based on comps.
Okay, so strong fundamentals, improving financials, but potentially priced for perfection already.
That's a good way to put it. The market seems to be baking in a lot of future growth.
All right. Let's pivot to how the market actually feels about stocks like PDYN, market sentiment. What did the report suggest for May 2025?
Generally positive, especially for high-growth tech and AI. Think NVIDIA, Palantir, lots of analysts buzz around them, though always with a caveat about high valuations and volatility.
So analysts were likely bullish on PDYN too. Buy ratings.
Probably. The report hypothesizes buy or outperform ratings would be typical for a company with PDYN's profile in that environment.
And what about trading? Lots of action.
Likely high volume, high volatility. Characteristic of these kinds of stocks. People are excited, but also nervous.
The report mentioned short interest.
Yeah, a hypothetical 12%. It's elevated. It means a decent chunk of the market is betting against the stock that the price will fall.
12% short interest. And the days to cover was 4. What does that tell us?
Days to cover is basically how many days of average trading volume it would take for all those short sellers to buy back their borrowed shares. 4 days is an extreme, but combined with 12% interest, it shows significant bearish bets.
But it also creates a risk for the short sellers, right? A short squeeze.
Exactly. If good news hits, where the price starts rising rapidly for whatever reason, shorts might rush to buy back shares to cut their losses. That buying pressure can push the stock price up even faster. It adds to the volatility.
And options market activity. Anything interesting there?
The report suggests you might see high open interest in out-of-the-money calls, people making speculative bets on a big price jump. Or maybe puts, indicating bearishness or hedging.
So unusual activity could signal something.
Sometimes. A sudden spike in volume in certain options contracts might hint at upcoming news, or maybe inform traders making moves. But you have to be careful. Extreme bullishness in options can sometimes be a contrarian signal, meaning the optimism might be overdone.
Okay, so a mixed bag. Positive analyst ratings likely, but significant short interest suggesting skepticism too. Now, who actually owns PDYN? The ownership structure.
Right. The hypothetical breakdown shows significant institutional ownership. Think big tech-focused funds like Tech Growth Capital, Future Vision, maybe index funds like a Vanguard AI and Robotics Fund.
Having big institutions on board is usually seen as a positive, right? A vote of confidence.
Generally, yes. It lends credibility and potentially some stability. They often do deep due diligence.
And insiders. Management.
The hypothetical CEO, Jane Doe, and CTO, John Smith, are shown holding about 5% combined.
That seems decent. Enough to align their interests.
Yeah, 5% is a meaningful stake. It suggests their fortunes are tied to the company's success, which is what you want to see. Beyond the top holders, ownership would likely be pretty diffuse, as is typical.
Is the type of institution important?
Very. Are they long-term investors focused on fundamentals? Or are they more momentum-driven traders? The quality and investment horizon of your institutional base matters.
Got it. Okay, business, management, financials, sentiment, ownership. Now for the risks. The report uses a SWOT analysis. Strength, weaknesses, opportunities, threats.
Yep, let's break it down. Strengths. They mention proprietary AI algorithms, strong customer ROI demonstrated early on, that scalable AIAS model, experience management, recurring revenue streams, and a strong balance sheet.
All sound good. What about the weaknesses?
Well, being relatively new means brand recognition might be low. They could be reliant on a few key tech people.
Why, key personnel risk.
The constant need for high R&D spending is a pressure point.
Huh.
That potential for low license utilization we talked about, and maybe customer concentration risk if too much revenue comes from just a few clients.
Okay, opportunities, where's the upside?
Lots of potential given the market, expanding into new industries or geographies, tapping into that rapid overall market growth for AI and supply chain and automation.
Developing new AI applications.
Exactly. Strategic partnerships with other tech companies, maybe M&A to grow faster or acquire new tech, and getting more SMEs, the smaller guys, to adopt their solutions.
Makes sense. Now, the threats. What keeps management up at night?
Competition is a big one. Intense pressure from large players and nimble startups.
Technological obsolescence. Things changing too fast.
Yeah, absolutely. The Red Queen effect, you have to run fast just to stay in place in AI. Cybersecurity is a huge threat, given the data they handle.
What else?
Economic downturns hurting customer spending. Potential U.S. tariffs impacting tech costs that's specifically mentioned for 2025.
Tariffs. Let's dig into that. What's the potential impact?
The report mentions a hypothetical 20% IEEPA tariff on China, plus rising Section 301 tariffs. Even as a software company, PDYN could be affected if hardware components they rely on or their customers rely on get more expensive.
So indirect costs, maybe, or impacting customer budgets.
Both are possible. If their customers in manufacturing face higher costs, they might cut back on tech spending. The report even includes a scenario analysis: low, medium, high impact on PDYN's costs, margins, pricing, and demand due to these tariffs.
It mentions a rule on AI chip exports being rescinded. Is that a counterbalance?
It might help slightly with access to certain advanced chips, but the report emphasizes it doesn't really negate the broader potential impact of tariffs across the tech supply chain. It's still a significant uncertainty.
Okay, so tariffs are a key external threat. What else on the SWOT list?
Regulatory risks are big data privacy rules, AI ethics guidelines, demands for transparency. Attracting and retaining top AI talent is a constant battle in this field.
Right, the talent war.
And the risk of AI solutions becoming commoditized over time, losing their pricing power. Plus, that whole area of responsible AI, ensuring fairness, avoiding bias, is becoming crucial for trust and reputation.
Wow, okay. A lot to consider on the risk side. So let's try to bring this all together. We've done the deep dive. What's the bottom line on Palladyne AI based on this May 2025 report?
Well, you've got a company with a really compelling growth story, operating in exciting high-growth markets. They're using innovative models like AIS and exploring pay-per outcome.
And the financials are improving, moving to profitability and positive cash flow.
Right, those are definite positives. But the headwinds are significant: intense competition, the crazy pace of tech change, those potential tariffs, regulations.
And the valuation seems steep.
That appears to be the main sticking point from a value investing angle. The report's intrinsic value estimate suggests the hypothetical market price back then was already quite high, offering little to no margin of safety.
Those high PE and PS ratios reflecting very optimistic growth expectations.
Exactly. So you could maybe call PDYN a good company, but potentially at a fair to high price. Not necessarily the fair company at a wonderful price that value investors hunt for.
Especially given the competitive intensity and the sheer speed of change in AI.
Right. So the investment outlook from the report, as of that date, leans towards caution. Avoid, primarily due to that lack of margin of safety.
So if you were watching PDYN or this sector, what would you keep a close eye on going forward?
You definitely monitor those growth rates. Can they sustain them? Track the ROIC. Are their investments paying off? Look for evidence of a strengthening moat.
How are they allocating capital? What are competitors doing?
Exactly. And how are they adapting to new tech? And of course, watch the overall market. Any significant correction might change the valuation picture.
Okay. Now, before we finish, you mentioned something earlier, a surprising detail, an overlooked cost for AI companies.
Ah, yes. We talked about the rapid pace of AI, the constant innovation needed, that Red Queen effect.
Right, running just to stand still.
Well, think about what that costs. The often overlooked factor is the sheer, continuous, substantial investment needed in R&D just to remain competitive.
So it's not just a one-time investment to build the tech.
Not at all. It's an ongoing, potentially massive drain on resources, and this relentless R&D spending can seriously hinder a company's ability to generate sustained free cash flow, even if revenue looks fantastic.
Huh. So high growth doesn't automatically mean high free cash flow long-term, because so much gets plowed back into just keeping up.
Precisely. It's a hidden drag that can really impact long-term profitability and investor returns in AI. Definitely something critical to factor into your analysis.
That's a really great point, a crucial nuance to remember when looking at AI investments. Thanks for breaking all that down.
My pleasure. It was a good deep dive.
It was. And thank you for joining us for this exploration of Palladyne AI Corp. If you found this helpful and want more analyses like this, definitely subscribe to the Stock Analytics AI YouTube channel.
And all the sources we base this discussion are linked in the description for you.
All right. And one final important note.
This analysis is based on information from May 15th, 2025. It's for informational purposes only and absolutely should not be taken as financial advice.
The AI sector is incredibly volatile, things change fast, and future results could be very different. Always do your own thorough research before making any investment decisions.